What's up? This is Dollars and Cents with David and Carlo. I'm David.
I'm Carlo.
And we created this show to help you understand different concepts on being able to grow your money, protect it, just build and build and build off of different concepts of financial strategies. And so thank you again for hanging out with us, and we really do appreciate it. So last show had to do with the concept of being your own bank. And there's a huge movement behind that right now. It's so incredible, especially nowadays with everything that's going down. Lots of banks that are going under. Do you really want to kind of continue to trust these huge banking institutions that really are in it for themselves and not for the little man? So the more control and the more power that you can take back with your own money really is ideal. And so we hope that you kind of find value in those concepts. Now it's important though to talk about the type of person that these investment vehicles are for, and really kind of who is this for? So in your experience, Carlos, types of people or the different ideas that have come across the different investors or movers and shakers out there that you've dealt with in the past.
Yeah. In my experience, obviously, I started off mostly working in middle-class markets. And middle-class markets, when it comes to permanent life insurance, they're doing anywhere between that $200 to maybe $1,000 range, right? But probably I would say more on the median of $200 to maybe $500 a month. Ideally, right, now that I've learned these policies and really how to get the juice, it's going to be for your higher income earner, right? And let me explain why. Because for high income earners, and I wrote these numbers down because I wanted to be accurate, if you're single and you file single taxes and you make over $146,000 a year, that's after deductions, AGI, adjusted gross income, Uncle Sam says you cannot qualify for Roth IRA. You make too much money, right? If you're a married couple and you file jointly with your spouse and you make over $230,000 adjusted gross income after deductions, you also don't get a Roth IRA. So you have higher income earners, right? Typically business owners. More often than not, those are the people that typically qualify. But there's lawyers, doctors that also make good amount of income. They don't get Roth IRAs. So where do they go for tax advantages when it comes to their money if they can't get the standard operating Roth IRA that everybody knows about? That's where cash value life insurance comes in, right? Both whole life and indexed universal life can be used in this regard. Because here's the kicker, right? Here's the point. And listen to this. There is no limit to the amount of money that you can contribute inside of a cash value life insurance policy.
On the flip side, a Roth or a traditional IRA is limited, right?
Yeah. So a traditional Roth IRA, right? If you're under the age of 50, you could only put $7,000 per year. If you're over 50, $8,000, which right now for most people that are, look, I need to kind of turbocharge my future. You may be seriously capped. So for the people that say, I don't make as much money as a single or joint, right? But I am putting more money in the Roth and I'm already maxed out. What else could I do? An IUL policy, because there is no limit to the amount you can contribute to that policy.
We, in previous shows, had talked about, those of you who are W-2 traditional W-2 employees where maybe your company does offer a 401k and maybe they are matching it. I don't think most are right now, but let's say even if they are matching it or they give you a maximum amount that you can contribute to that's still a great vehicle for you to continue to do so. But again, you may want to limit yourself on the amount of contribution up to the max that if they're matching you, what the company's going to be matching.
I'm so glad you brought up this point. It's a big question I get often. Should I stop contributing to my 401k and only do like an IUL, like you say? And my answer is it depends, right? And it depends on what? Number one, the match. If your company matches you, you should be contributing up to the match because that's free money, pending that you meet the vesting criteria, meaning for those matches to be yours, you may have to be there for at least a minimum of 3 years or 5 years. It all depends on the company. But that's free money. Now, I get people that are like, well, I am contributing 12% of my income, but I'm only being matched right, to 3 or 6%. I said, bring your contributions of your 401k down to the match. And that difference should be going into an after-tax vehicle, such as a permanent life insurance policy like an IUL.
Knowing, or even if you don't know, but your 401k, when you go to retire, you will be taxed on that money. And let me ask you, facetious question. Do you think taxes will be going up or down?
Oh my gosh, right. Well, right. Full disclosure, I'm pretty biased, right? Because I work in this field, right? But I think I ask that question almost at every seminar, everybody I talk to. Do you believe taxes will go, who thinks taxes are going to, raise your hand if you think taxes will be lower in the next 20 years than they are today. And nobody raises their hand.
Raising his hand back there. Too.
Nobody, man. Nobody believes that, right? And if you look at, well, why do I think that? Look at our deficit.
Right.
35 trillion in debt. Like, how are we going to ever pay that back? It's got to come from somewhere, right? And taxes seems to be an easy way to go and get a lot of money.
Easy. This is a thing that just popped up, but they're talking about unrealized gains now, taxing on that. We'll get into that later. But the reason why I bring that up is because, so again, if you're going to retire at 65 and you feel like your 401k is going to be sufficient to cover you for the remainder of your years, don't forget, you're going to get taxed on that money, and you're going to get taxed on whatever the tax laws are at that time. So we still have a lot of time in between to where, taxes are tough already as high as they are right now. If they come up with that unrealized gain, or if they come up with other different strategies to want to start paying towards that deficit, or in my opinion, probably just to pay for more wars or whatever, it's going to come from your money that you've saved. And so you have to understand, and most of us, to be quite honest with you, I don't think that we even know how our 401k works or what it looks like at the end. But hopefully through these shows, we can help you understand it a bit better. If you ever have any questions, specific questions, you guys can reach out to us any time, and we're happy to sit down and meet with you. But I thought it's important to talk about that because we don't think about that. We don't think for that far down the road. And it's just like, I got my 401k, I'm straight. It's look at what it's looking at right now. Also considering that is tied to the stock market. You can lose. You can lose your 401k, and a huge amount. So again, things to consider and things to think about. We talked about who these types of vehicles are for, and really a big portion of that group goes to business owners, and how they can use this IUL strategy to help grow their business, but also help their employees as well. Yeah. Right. There's different ways, and I say this lovingly, but there's a concept of a golden handcuff for you business owners out there that have employees and want to help your employees who have stayed with you for a while. Retention is huge for us business owners as well, but there are ways for us to help our employees, help them grow their type of retirement. Their retirement.
Yeah, let me elaborate on that. That's a big one. Thank you for bringing up that concept. And for you business owners out there, right? What this plan is called an executive bonus plan, and it's a discriminatory retirement plan, right? Because if you offer a 401k at your company, and this is also for small business owners who maybe can't afford to do a 401k because it's expensive, you need participation. If you run a company where you deal with a lot of turnover, like, man, it's hard to keep people because they just go. Or maybe you have a key person that, man, I'd love to take care of that guy, that gal. They're so good, and she's been with me. She's been with me from the jump, but I just can't put a 401k and all that together yet. Consider what I'm about to share with you with an executive bonus plan. Or if you're a large company, you already have a 401k, but you want to take care of a few people, or even one person. I just want to take care of this person. An executive bonus plan is where you can contribute money inside of an IUL policy, right? The company is the owner, the insured is the employee, and the beneficiary could be the employee's family or the company, or 50-50, however the company wants to do it. And you can create a vesting schedule with that cash value. Okay, so two things that you can do. Number one is it can be a deduction to the company, so you're saving tax money there. Number two, you can create a vesting schedule and say, hey, I'm going to do this for you from company dollars, right? David, you're my top guy, and I'm going to put $10,000 a year into this policy for you. Okay, I'm going to make the beneficiary your spouse, right? But for this cash value to be yours, you got to stick with me for at least 4 years.
It's not a bad trade-off.
It's a golden handcuffs, right? And you could use tax deductible dollars from the corporation to fund it.
All right.
So it benefits the business owner and it benefits the employee, and it gives the business owner peace of mind to know that they can have retention for solid people, solid employees, right? And it gives the employee peace of mind, like, man, I'm being taken care of. I got this tax-free thing that's being funded me by my company. So it's a win-win situation.
I love that concept. And for us business owners, we know what retention looks like and how hard it is to find the right person and really have them continue to grow with your company. And so shout out to Jessica. Thank you so much.
What?
We talked about who this is for. I think it would be important for us to talk about who it's not for.
Yes. Who's it not for, right? And this is something that, unfortunately, I learned later on in my career. Unfortunately, these policies are not designed for low income, right? And the reason why is because I get this question a lot, David. I want one of those IUL policies. I'm 50 years old and I saw your video on YouTube and I want one of those tax-free retirements. And I say, okay, you're 50 years old? Yeah, let's talk about that. How much would you like to contribute? Can I contribute $150 a month and I want to retire here in the next 5 to 10 years? Can you do that? Yes. Should you do it? Probably not, because if you're not funding these policies with at least 10 times your age for at least 10 to 15 years, unfortunately, it's just not worth doing. So that means if you're 50 and you're like, I want one of these policies, if you can at least do $500 a month for at least 10 to 15 years, I probably would not consider an IUL policy, right? Can you start one with less? Yes, you can. But unfortunately, you're just not going to get the juice out of this, because no matter what, you cannot alleviate the cost of insurance and the fees for this policy. And if you're only contributing a fraction of that, it's getting chewed up by the policy.
And that goes back to how these policies are structured up front. And so, going back to some of these MLM companies that unfortunately might find that person who can only do X amount, low amount, and then they tell them, yeah, no problem, we can get you to where you need to be at, with not really divulging all the information that they should. Or even knowing that really, just because they weren't properly trained and whatnot. So
properly, right? Yeah, so I would say most of those are hit and runs, man. Unfortunately, is they're being max commissioned because whatever they're contributing, they're getting the maximum amount of death benefit. And again, the way that we're paid commissions as agents is on death benefit. The higher the death benefit, the higher the cost of the policy, the higher the commission to the agent. The lower the amount of death benefit in the policy, the lower the cost of the policy, the lower the commissions to the agent. So you want the least amount so that you're building some cash value.
Right. We will always be transparent with you guys. We want to make sure that you guys get the full grasp and idea behind these concepts. And so we want to make sure that you all understand that, the idea behind this show was to be upfront and transparent and let people know that there are these situations that happen. But really, the more that you can inform and educate yourself on these concepts and these particular different strategies, the better off that you're going to be. So please lean on us as much as possible. Give us a call, shoot us a DM, check us out on Instagram, or visit us at our office in downtown Chula Vista. But we want to be available for you at all times, and really, we hope to continue to grow with you all out there. So we are at the end of this episode. Carlo, thank you so much again. I appreciate all your information. I thank you guys for checking us out, and we'll see you on the next episode. Peace.